So another month of central bank inactivity passes us by, at least with the Bank of England in mind, as Governor Mark Carney leaves interest rates unchanged at 0.5% and quantitative easing unchanged at £375 billion. We've still got the Bank of England's next meetings to come, 5th of November, 10th of December to look forward to, if that's the right verb, but it seems likely we will pass yet another year without a rate hike. Now, the Bank of England last increased borrowing costs in 2006, and its last move down was in 2009. The market still seems confident Carney and co will increase borrowing costs in 2016, although the governor's thinking may well be influenced by overseas events as well as those at home. After all, the US Federal Reserve makes its next decision on 28th of October, and then one more for this year on the 17th of December. Note, one Fed member actually voted for a rate cut in September. The Bank of Japan is facing calls to increase the scale of its latest QE scheme for the second time when it meets on the 30th of October. And some pundits already believe the European Central Bank will let its QE scheme run beyond its current deadline of September 2016, after recent changes to accelerate its monthly purchase programme and broaden the scope. So could, just could, the next move in monetary policy be looser, not tighter? Hello, I'm Russ Mould, AJ Bell's Investment Director, and this week's episode of Breaking the Mould is going to think about the unthinkable and look at not just rate hikes from the Bank of England, but rate cuts, just in case, no matter how unlikely they may seem. After all, if anyone else loosens and Britain tightens, the pound would probably rocket, slow the economy right down, plus, of course, interest rates influence share prices in three very important ways. When rates rise, higher returns on cash can tempt investors to keep their money in the bank or take it out of equities and park it there. Lower interest rates have, generally, according to history, boosted stocks as investors have bought them in the search for improved returns, albeit in exchange for higher risk. When rates rise, bond yields tend to go up, again persuading investors to seek higher returns from instruments which are relatively less risky than stocks. If rates are cut, bond yields tend to fall, potentially again persuading some to look at stocks and shares as an alternative, again in exchange for higher risk. And third, interest rates are a key part of the discounted cash flow calculation, or DCF, which is fundamental to long-term equity valuations. In simple terms, the higher the interest rate you use, the lower the valuation. The lower the rate you use, the higher the valuation. So a rate cut could be potentially interesting. Well, that's the theory, but let's actually get down to brass tacks. And how has the UK stock market actually performed during times of higher and lower interest rates? Now, this first chart shows the Bank of England base rate and the FTSE All-Share all the way back to 1965, 4 years before I was born. Now, let's look separately at times of rising and falling rates after that. In the knowledge history may be a guide to what could happen, but is by no means a guarantee. Now, our analysis of 10 cycles of higher rates and 11 rates of lower ones in the UK since 65 shows that British stocks do perform better when the Bank of England is loosening and rates are going down, but the results during periods of tightening and higher rates aren't uniformly awful. Our research shows that during a cycle of lower rates, the FTSE All-Share Index rises by 25.1% on average from the first cut to the last. And during a cycle of higher interest rates, the index rises by 11.4% on average from the first hike to the last. Now, that doesn't sound too bad, but the averages do conceal some very interesting variations. This second graphic shows that those averages contain a very wide range of performance across the 10 rate rise cycles, and there's an equally wide range for the 11 rate cutting cycles. Check out the last two here, right over here, both horrendous falls. So lower rates is not a guarantee of higher markets, even if the trend is generally favourable, the average is good. And of late, stocks have actually done worse after a rate cut than they have after a rate hike. It was only QE that steadied the ship last time. Now here's another perspective. The FTSE All-Share has fallen just 3 times in 10 over the 6 months after a rate hike, for an average gain of over 1.8% over a 6-month period after a hike. It's fallen 3 times in 11 in the 6 months after the first cut. And again, the last two outcomes were really pretty ugly. Now that may surprise you, but it certainly suggests investors need to be careful if their strategy is just to rely on cheap central bank money to get their portfolios going. If the Bank of England does cut rates rather than raises them, history shows you could even get a fall, not a guaranteed rise in stocks. And this kind of makes sense, as a cut, again no matter how seemingly unlikely, would probably be in response to a downturn in the economy, disappointing corporate profits and possibly even deflation fears, none of which have historically been great for share prices. So yes, we must all keep an eye on the Bank of England, but interest rates are just one part of the equation. We must all also study profits growth, valuations too, and the best defence in the long term could be to stick to firms with a strong operating model, as shown by pricing power, healthy balance sheet and competent management at a reasonable valuation. Thank you for watching, and I look forward to seeing you next time.